Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into DexCom, ticker DXCM.
And our mission today, well, it's pretty critical for anyone watching the medical device space, or just investors generally. We're digging into the latest Q3 2025 filings from DexCom. That's for the period ending September 30th, 2025.
Right.
And this deep dive, it's really about trying to hold two almost opposing narratives together. On one hand, you've got this story of incredible growth, market dominance.
Yeah, the tailwinds look huge.
Exactly.
Yeah.
But then you've got the immediate reality. Severe high-stakes problems, operational issues, quality control, major regulatory challenges that really came to a head this quarter.
So understanding that risk side is crucial.
Absolutely. For you, the listener, getting a handle on the scale of these risks is, well, it's the only way to really judge the potential reward accurately.
It's a fascinating paradox, isn't it? You have this explosive market adoption, a company clearly tapping into a massive need, and it's funded by, well, a really strong balance sheet. Seems like immense strength.
It does on the surface.
But that strength, it sounds like it's being tested right now. We're moving from maybe financial friction to these potentially really damaging reputational and regulatory threats, especially with the FDA's findings.
That's the core conflict.
Let's start, though, where things look, well, almost invincible. The headline financials, Q3 2025. The numbers were genuinely big.
Oh, they absolutely were.
Yeah.
Look, the company's riding this global wave of CGM adoption, continuous glucose monitoring. And the top line, undeniable proof that the market wants this.
So it was a number.
Worldwide revenue hit $1.209 billion just for the quarter.
Wow. Billion with a B.
Yep. And to give that context, that's a solid 22% year-over-year increase, reported basis. Even if you strip out currency effects, the organic growth was still 20%.
20% organic. Okay.
Yeah, the underlying momentum, it's definitely still there, firing on all cylinders, you could say.
And critically, that growth isn't just coming from one place, right? It's not just the U.S.
Correct. That helps de-risk things a bit. The expansion is truly global. U.S. revenue grew 21% year-over-year. That's pretty formidable for what's already a pretty established market.
Internationally.
International was up 22% reported, 18% organically.
Mm-hmm.
Management actually called out France and Canada specifically, so they were top contributors.
Why France and Canada?
Mostly driven by getting new coverage for basal insulin users in those regions, opening up new patient populations.
Okay, so the revenue engine is clearly running hot. How did that actually flow down to the bottom line? Was profitability keeping pace?
It really was. It was actually a record quarter for efficiency, which makes the later points even more stark. GAAP net income was $283.8 million.
Okay.
Which is, wait for it, 111% year-over-year increase.
111%. Wow.
Astronomical growth there. And the number Wall Street often watches closest, diluted non-GAAP EPS earnings per share, hit 79.61 cents.
61 cents.
Which, for them, represents the highest recorded profitability in the company's history, ever.
Okay, so record profits. That must have given management some confidence. Did they update guidance for the full year?
They did. They raised the full-year revenue guidance, now expecting between $4.630 billion and $4.65 billion.
So still projecting strong growth for the year overall.
Yeah, that signals about 15% growth for the full year 2025. Still very healthy growth.
Okay, everything you've laid out so far just screams category winner, flawless execution. But, we promise a deep dive into the conflict here.
Right.
If the growth is this strong, profits are records, revenue guidance actually went up.
Yeah.
Where's the immediate financial warning sign? Where's the hint of trouble beneath that shiny surface?
The immediate red flag, the thing the market definitely noticed, is gross margin erosion.
Gross margin, okay.
Right after that impressive revenue guidance hike, management then lowered the 2025 non-GAAP gross profit margin guidance.
Lowered it. From what to what?
It was previously forecast at, a pretty healthy 62%. They dropped it down to approximately 61%.
Wait a minute, just 1 percentage point. From 62 down to 61. I mean, for someone just looking at that huge revenue growth, that might not sound like a disaster. Why is that single percentage point drop such a critical signal? Why does it suggest weakness?
Because it signals potentially millions of dollars lost just to internal friction. And maybe worse, it suggests a breakdown in operational discipline somewhere.
Okay.
When you're forecasting almost $4.6 billion in revenue like they are, losing 1 full percentage point of gross margin, that means you're sacrificing over $46 million in potential gross profit. Just poof. Gone.
46 million. Okay, that puts it in perspective.
And in a market like this, medical devices where pricing is always under pressure from competitors, from payers, sacrificing margin because you can't run your own operations efficiently. That's a structural problem. It's not just a temporary blip.
Right. It hits your ability to compete on price. It hits shareholder value.
Immediately. Exactly.
So we know the margin pressure is real and significant financially. What exactly did they say was causing it? What are the operational drivers behind this squeeze?
The company pointed directly to two main things.
Yeah.
And they actually said it was roughly a 50-50 split in terms of impact for the year.
Okay, 50-50. What were they?
First, higher than expected scrap rates at their manufacturing facilities.
Scrap rates, meaning they're literally just throwing away products they made.
Essentially, yes. Product that doesn't meet quality standards, faulty components, that sort of thing, more than they planned for.
Okay, that's half the problem. What's the other half?
Increased costs due to expedited shipping. Freight costs.
So paying premiums to ship things faster, which probably means they're trying to make up for delays or poor yields from the manufacturing side where the scrap rates are high.
That certainly seems to be the operational reality they're describing. Yeah, high scrap rates. That points right at fundamental quality control issues or production yields that just aren't hitting the targets.
And is there evidence of this, like elsewhere in the financials? Does it show up on the balance sheet?
You can see it validated right there. The charges they take for excess and obsolete inventory, basically, components or finished goods they couldn't use or sell those, grew significantly.
How much?
For the first 9 months, ending September 30th, 2025, those charges hit $53.0 million.
53 million. Okay.
Compare that to the same period in 2024. It was just $32.7 million.
Wow, that's a huge jump, almost $20 million more in just 9 months.
It's a massive escalation.
Yeah.
And it directly supports that narrative. Production seems inefficient, and defective or unusable product is piling up.
That's a really crucial link. So the market's pulling product out the front door like crazy, but the cost structure, the internal operations, they're actually working against them right now because of these manufacturing bottlenecks.
It seems to be the case.
Okay. Before we pivot to the, frankly, kind of terrifying regulatory side of this, let's quickly touch on their financial foundation, because facing these headwinds, you need stability, right? You need a fortress balance sheet.
And they definitely have that. The balance sheet is, without a doubt, their biggest source of stability right now. They finished the quarter with over $3.3 billion in total liquidity.
$3.3 billion.
Yeah, that's cash, cash equivalents, marketable securities all combined. To break it down, it was about $1.84 billion in actual cash and another $1.49 billion in short-term marketable securities.
That is a staggering amount of money. A huge war chest. How are they deploying that capital? Or managing it, especially thinking about debt? Do they have much debt?
They do have some debt, but they're managing it very confidently. And this is actually a key signal, I think, of management's belief in their future cash flow. They've got some senior convertible notes coming due soon, November 15th, 2025.
Okay, how much?
That's about $1.21 billion.
$1.2 billion. That's significant. How are they planning to handle that maturity?
They stated their intent is to repay it entirely in cash.
Entirely in cash? Not using stock, even though they're convertible notes. Why is that choice cash versus potentially converting to equity so important for investors to notice?
It's critical. It signals huge confidence from management. They believe they can service that billion-dollar debt without diluting existing shareholders. By paying in cash, they avoid issuing what could be, maybe 15 to 20 million new shares.
Right, which would obviously hit earnings per share.
Exactly. It maximizes EPS for current shareholders. It's also a tangible way for them to signal they think the current stock price is undervalued. They'd rather use cash than issue stock at these levels.
So they think the stock's cheap, and they think they can generate the cash needed internally. Are they doing anything else with that cash, like buybacks?
They are. They specifically mentioned they are actively executing their 2025 share repurchase program, and the quote was that management is very, very bullish on this business.
Very, very bullish. That's strong language.
It is.
But it brings us right back to that central conflict, doesn't it? If management is so bullish, buying back stock, paying off debt in cash, why are these external critics raising red flags, talking about things like channel stuffing or alleging, 15 straight quarters of margin decline? How do we square that confidence with these serious accusations?
And this is where we have to pivot sharply. We move past operational friction, which might be manageable, and into potentially catastrophic territory. Regulatory noncompliance, and the reputational fallout.
Yeah, the operational noise, the scrap rates, that's concerning from an efficiency standpoint. But it sounds like it pales in comparison to what the FDA found.
It really does. These are high-stakes findings regarding unauthorized changes to their core products.
Okay, let's unpack the FDA Warning Letter. This came out March 4th, 2025. And reading the summary, this wasn't just some minor paperwork issue. It went right to the heart of the G6 and G7 sensors, their flagship products. What specifically did the FDA find fault with?
The core finding was this. DexCom modified the G6 and G7 sensors. Specifically, they replaced a critical component, coating, it's called the resistance layer, with a new material they developed in-house.
Okay, they changed a component. Companies do that. What was the violation?
The violation was that they made this major design change without submitting the required paperwork to the FDA. Specifically, a new pre-market notification known as a 510K.
Okay, let's clarify for the listener. What is a 510K submission, and why is skipping it such a serious regulatory breach, especially for a medical device?
Think of a 510K as the legal dossier a company uses to prove to the FDA that their modified device is substantially equivalent, meaning just as safe and effective as the device that the FDA already cleared for the market.
Right.
When you change a critical component, especially one that directly impacts the device's accuracy, like this resistance layer, a 510K is absolutely mandatory. By skipping it, DexCom essentially bypassed FDA oversight on a change that directly impacts patient health. They skipped the crucial step of proving the new version was safe.
And this wasn't just a procedural foot fault. The consequences seem much more serious because apparently DexCom's own internal data showed this new unauthorized component wasn't as good.
Exactly. That's one of the most damning parts. The FDA's warning letter explicitly referenced DexCom's internal studies. And those studies showed that the sensors made with the new, unapproved material has significantly greater variability compared to the original FDA-cleared material.
So they didn't just fail to tell the FDA about the change. They seemingly knew the new component was potentially worse.
The data indicated it performed differently, with greater variability. That's what the FDA highlighted based on DexCom's own findings.
Okay, significantly greater variability. Let's translate that. For a patient using this device, maybe someone relying on it to dose insulin, what does that mean in the real world? What's the risk?
It translates directly into safety risk, a lack of trust in the readings. The FDA themselves stated that this difference in variability suggested greater clinical performance variation, meaning it led to larger inaccuracies. And for users making critical decisions based on that data, like how much insulin to take a potentially life or death decision, the FDA stated this poses higher risks.
Higher risks, okay.
And because of this unauthorized change, this major change that affected performance and wasn't cleared, the FDA officially deemed the G6 and G7 devices shipped with this new component to be both adulterated and misbranded.
Those words adulterated and misbranded sound incredibly serious, especially for a medical device company. We need to define what those terms legally mean in this context. What's the implication?
They're chilling legal terms. To be deemed adulterated essentially means the device's quality, purity, or safety standard was compromised, which happened here, according to the FDA, because the unauthorized component change degraded the performance and accuracy.
Okay, and misbranded.
Misbranded means the labeling was deceptive or misleading. The label described the original safe FDA-cleared product, but it no longer accurately described the actual product being sold with the unapproved, more variable component. It implies a failure to meet the promises made to the FDA and ultimately to patients.
Wow. So this goes way beyond just a manufacturing slip-up. It really strikes at the core legal integrity of their main products.
It absolutely does.
And that level of regulatory breach, well, it creates the perfect environment for intense scrutiny from critics, right? Which brings us to the short seller reports, particularly from Hunter Brick Media. They're openly short the stock, DXCM.
Yes, and they took the FDA's formal findings and connected them to some really disturbing allegations about systemic patient safety flaws.
What kind of allegations are we talking about?
The reports gathered anecdotal evidence citing MIGE database reports and patient stories. They highlighted examples of hospitalizations, even near-death events, allegedly linked to faulty G7 readings.
Near-death events? Like what?
They cited the tragic case of a man named Billy Sosby, who apparently passed away in June, with the reports connecting it to G7 issues. Another user, Bob Hawkinson, reportedly passed out while driving because his G7 allegedly failed to warn him about dangerously low blood sugar.
That's terrifying. Passing out while driving.
There were also reports of users being found unresponsive, rushed to the ER because their G7 supposedly failed to communicate critical low glucose data to their connected insulin pump.
These aren't just abstract data points or minor glitches. These are potentially life and death situations for people relying on these devices. How does the human cost of these alleged failures amplify the reputational damage, especially as DexCom tries to expand into markets like non-insulin users, where maybe device adherence is more voluntary?
The potential reputational damage is just magnified exponentially. If patients who absolutely need this device, the insulin-dependent group, are facing these kinds of alleged failures, trust just evaporates.
Yeah.
And it wasn't just these catastrophic events. The reports also documented a high frequency of more, let's say, frustrating mechanical complaints about the G7.
Like what?
Things like units just not working right after setup, constant Bluetooth connectivity problems, a major headache for users, adhesive failing, the sensor falling off early, and apparently a high rate of what they called out-of-box failures, issues just getting the device deployed correctly.
So reliability issues on top of the accuracy concerns raised by the FDA. And how did this stack up against their main competitor, Abbott, in these reports?
This is where it gets really stark competitively. Hunterbrook claimed, based on their analysis of complaint data, that DexCom receives 22% more accuracy complaints than you'd expect based purely on their market share.
22% more complaints than expected.
Okay, but Abbott's rival product, the Freestyle Libre 3, Hunterbrook claimed it logs 68% fewer complaints than expected based on its market share.
68% fewer. That suggests a huge gap.
It implies a significant perceived difference in product quality and reliability, at least based on that data analysis. And that perception gap, especially when combined with the official FDA findings, makes the job of keeping customers and attracting new ones incredibly difficult.
Okay, that covers the product quality and safety allegations. But there was a second major pillar to the short reports, wasn't there? Concerns about the accounting, financial maneuvering.
Yes, that's the other shoe dropping, according to the critics. Forensic analysts cited in these reports pointed directly at a metric called Days Sales Outstanding, or DSO.
DSO. That measures how quickly a company collects cash after making a sale, right?
Exactly. It's the average time it takes to turn a sale into actual cash in the bank. And DexCom's DSO surged to a record 106 days in the quarter.
106 days. Is that high?
It's not just high for them, it was a huge jump. It represented an astonishing increase of 20 days compared to the same quarter the previous year.
A 20-day jump in collection time in just 1 year. For a company this big, that seems like a massive red flag. What does a forensic accountant read into a spike like that?
It immediately raises concerns about potentially aggressive accounting practices, maybe even manipulation of revenue recognition.
How so?
When DSO climbs that sharply, the interpretation is that reported revenue is outpacing the actual cash coming in. This can suggest a couple of things. One, maybe excess product is being pushed into distribution channels. That's known as channel stuffing.
Selling more to distributors than they can quickly sell through to end users just to make the quarterly sales number look good.
That's the concern. Or it could mean they're offering unusually lenient payment terms to distributors to incentivize them to take more product. Either way, it increases the risk that they're recognizing revenue prematurely booking sales before the cash is really assured, possibly just to hit those Wall Street targets.
And does this accounting concern connect back to the operational problems we discussed earlier? The short report also claimed, I think, that gross margin had fallen for 15 consecutive quarters.
It does try to weave those threads together. The narrative presented by the forensic analyst is essentially product quality suffered, maybe due to those unauthorized component changes aimed at protecting margins, which then led to costly operational fixes like higher scrap and freight costs, and potentially necessitated aggressive accounting tactics like channel stuffing, reflected in the high DSO, just to maintain the appearance of smooth, explosive growth, even while operational efficiency was actually struggling.
So the core issue becomes trust. Trust in the reported numbers, trust in the quality, trust in the execution.
Exactly.
Okay, so given all this swirling noise, the FDA warning, the safety allegations, the accounting scrutiny, how did DexCom management address the actual business impact? Did they admit it affected, say, new patient signups in Q3?
They did acknowledge some impact. The CFO, Jareem Sylvain, confirmed on the earnings call that the noise surrounding the quality issues and the negative press had likely been a bit of an impact on new starts during Q3.
A bit of an impact.
Yes. He said the quarter ended up being slightly below a record number for new patient additions, so they're conceding it created a headwind.
But the interim CEO, Jacob Leach, he's pushing back hard, right? Saying the issues are fixed, the worst is over.
He is maintaining a very strong counter-narrative. His position is that the issues, particularly the high scrap rates and those out-of-box failures, have been solved in the factory,
Solve it in the factory.
and that management is now confident in the exceptional quality of the sensors currently being produced. They're projecting a return to record new patient starts in Q4
Yeah.
and expect strong growth for the full year 2026, relying only on the coverage they already have in place.
But how does a fix in the factory address the core FDA finding? The FDA's issue wasn't just bad batches, it was an unauthorized major design change that required a whole new 510(k) submission because it affected performance. Why should investors believe a factory tweak satisfies that fundamental regulatory requirement or rebuilds trust after an official adulteration ruling?
That is the absolute crux of the credibility challenge facing management right now. Investors have to weigh Leach's strong assurances against the formal FDA determination. Has the underlying component issue been fully resolved and properly documented with the FDA? That remains a key question.
And this risk, the trust deficit, it seems amplified when you think about their growth strategy, right? Moving more into the type 2 non-insulin market. These aren't necessarily people for whom the CGM is life or death critical in the same way it is for someone on an insulin pump. Adherence might be more fragile.
Precisely. And we actually see hints of this in the utilization data they provide. For the high-risk users, like those on automated insulin delivery AIG systems, utilization rates are incredibly high, often above 90%.
Makes sense. They need it.
For other intensive insulin users, maybe multiple daily injections, it's still very high, 85% to 90%. Even for basal-only insulin users, it's strong, 80–85%.
Okay. But what about the non-insulin type 2 group, the huge future market?
That's where you see a noticeable drop. Utilization rates for non-insulin T2D users are estimated around 75% to 80%.
So maybe 20–25% of that group aren't using it consistently, even if they have access.
Right. And if the product is perceived as unreliable, inaccurate, or just frustrating to use because of quality issues like connectivity or adhesive problems, that 20–25% non-adherence rate in their biggest future growth market could easily climb higher. It could potentially choke off that crucial growth vector if the trust isn't rebuilt.
That lower adherence rate really highlights why they have to get the quality and regulatory piece right. They need to innovate their way out of this mess.
Let's shift gears then. Let's look at that innovation pipeline, the massive market they're chasing. Can the potential reward possibly outweigh the significant risks we've just defined?
Well, the bull case absolutely hinges on the size of that total addressable market, the TAM. It remains immense. And the trend towards CGM use is secular, meaning it's a long-term shift.
And the main focus is that type 2 non-insulin group. That's the core growth engine, yes. The NIT segment, non-insulin treated. We're talking about potentially 25 million or more Americans who have type 2 diabetes, don't use insulin, and currently lack broad, easy access to CGM technology.
25 million plus, that's huge. And DexCom sees getting access for this group as key.
Absolutely. They have a big randomized controlled trial in RCT underway specifically for this T2D NIT population. They expect the data from that trial to be the cornerstone for advocating for expanded coverage. Basically proving the clinical benefits to convince payers, insurance companies to cover CGMs for this massive group.
Have they made any headway already in getting coverage for these non-insulin patients?
Yes, significant progress actually.
Yeah.
They've already locked in coverage deals with 3 of the largest commercial pharmacy benefit managers, the PBMs.
The big middlemen who control drug access.
Exactly. Those deals give DexCom access to nearly 6 million type 2 non-insulin patients through commercial insurance right now.
6 million covered lives already. That's about half the commercial market for that group.
Roughly half, yeah. And management's view is that the basal insulin market alone, which is currently maybe 20–25% penetrated, should eventually reach something like 60% penetration. So it's still a huge runway, even in adjacent segments.
And we shouldn't forget the even bigger potential market beyond diabetes, right? The general health and wellness pre-diabetes crowd.
Correct. That taps into the enormous pre-diabetes population. Estimates around 98 million Americans.
So 98 million.
This is the market their over-the-counter system, Stelo, is targeting. It's aimed at both T2D non-insulin users and those pre-diabetes individuals who want metabolic health insights but don't need or want a prescription.
Okay, so the market opportunity is clearly vast. What about that critical clinical catalyst you mentioned, the big trial for the non-insulin type 2 group? When is that data expected?
The readout for that T2D NIT randomized controlled trial is highly anticipated. They're saying early next year, which likely means early 2026.
Early 2026. And that data is seen as make or break for unlocking broader coverage.
It's absolutely crucial. Management views it as the next major proof point needed to persuade payers globally to expand coverage beyond the current, mostly insulin-focused base. It's about positioning CGM as a standard tool for almost all diabetes management and maybe even prevention.
Okay, let's talk about the actual products designed to capture these opportunities. What are the key innovations coming that might help restore faith, maybe distract from the recent issues?
Well, the biggest near-term hardware upgrade is the rollout of the G7 15-day system.
15 days, up from the current G7's 10-day.
Exactly. It's billed as offering the longest-lasting wearable CGM system currently available, giving users 15.5 days of continuous wear from one sensor.
Longer wear time is obviously more convenient. What about accuracy, given the recent concerns?
They are heavily emphasizing accuracy here. They claim it offers best-in-class accuracy, citing a MARD of 8.0%.
MARDs. Okay, remind us what that stands for and why 8.0% is significant.
MARD is mean absolute relative difference. It's basically the standard measure of CGM accuracy, how much the sensor's reading differs, on average, from a lab-quality blood glucose measurement. Lower MARD is better.
And 8.0% is good.
8% is extremely good. Historically, that level of accuracy was only achievable with finger sticks. Getting down to 8.0% in a wearable sensor, especially one lasting over 15 days, is a real technological achievement. It reduces the user burden, should improve adherence, and directly counter some of the accuracy criticisms.
Assuming it performs as advertised consistently,
Yeah.
how's the rollout going in terms of getting payers, insurance, to cover this new 15-day version? Is it complicated?
Actually, the access side seems exceptionally well managed. They've apparently finalized contracts with Medicare, with every major commercial payer, and with the commercial DME partners, the durable medical equipment suppliers.
All at the same price.
All at the same net price, back to DexCom. Now, the full transition from the 10-day G7 to the 15-day G7 will take time, probably a couple of years, to fully switch over the user base. But once it's done, this longer-lasting device is expected to be significantly positive for their gross margins, if they've truly fixed those manufacturing scrap rate issues.
Right. The margin benefit only happens if they can make it efficiently. What about that over-the-counter product, Stilo? You mentioned it targets the wellness market. Is it actually selling?
It seems to be a quiet but definite success story so far. Steel got FDA clearance back in March 2024, specifically for non-insulin users, and DexCom announced it has already surpassed $100 million in revenue in its first 12 months on the market.
$100 million from an OTC product in year one. That's pretty strong validation.
It really underscores the latent demand out there for accessible, non-prescription CGM technology for people focused on broader metabolic health, not just diagnosed diabetes.
Are they innovating on the software side too, making the data more useful?
Yes, definitely. They're putting a heavy focus on software, particularly with the launch of something called DexCom Smart Basal.
Smart Basal. What's that?
It's an innovative software module built right into the main DexCom app. It's designed specifically for people starting on basal, long-acting insulin. It uses the CGM data, the daily glucose patterns, to help simplify, personalize, and speed up the process of figuring out the right basal insulin dose, what doctors call titration.
So it tries to take some of the guesswork and fear out of starting insulin.
Exactly. It's aimed directly at reducing that apprehension people feel, making the process smoother, and hopefully leading to better outcomes. It adds significant value beyond just the sensor hardware itself.
And looking further out, any hints about the next generation platform, the G8?
They've started talking about the G8 platform. They describe it as an incredibly important future platform, primarily because it's being designed as a multi-analyte platform.
Multi-analyte, meaning it measures more than just glucose.
That's the goal. The main possibility mentioned so far is adding ketone monitoring alongside glucose.
Ketones. Why is that significant?
It's huge. Measuring ketones opens up applications beyond traditional diabetes management. Think about people on ketogenic diets or doing intermittent fasting. But even more critically, it could be used for diabetic ketoacidosis, DKA, protection. DKA is a dangerous, potentially fatal complication of very high blood sugar, especially for type 1 diabetics. A sensor that warns about rising ketones could be a lifesaver.
Okay, so the innovation pipeline looks robust. The market opportunity is vast. The foundation for growth seems solid if they execute and overcome the current issues, but they don't operate in a bubble. Let's talk competition and maybe the biggest external risks.
Right. The competitive landscape is fierce. The primary rival, no surprise, remains Abbott with its freestyle Libre system.
Abbott, they're the volume leader globally, right?
Yes, Abbott is often cited as the global leader in terms of CGM unit volume. And they're not standing still. They're launching their own OTC system called Lingo here in the U.S., directly competing with Stilo. And they're fighting DexCom tooth and nail on performance metrics.
We mentioned DexCom's G7 15-day boasts that 8.0% IARD. What's Abbott claiming? Is Libre as accurate?
The battle is relentless. Abbott actually funded a study. Important to note who funded it, but that study claimed their Freestyle Libre 3 beat the G7's accuracy over the full duration of sensor wear.
So dueling accuracy claims.
Pretty much. Both devices are incredibly accurate compared to older tech, but this constant back and forth over who has the absolute lowest ARD gives Abbott ammunition, especially when DexCom is dealing with these quality complaints and the FDA warning related to accuracy variability.
Does DexCom have any specific feature advantage right now?
One feature often highlighted is DexCom's Urgent Low Soon Alert. It's a predictive alert designed to warn users before they hit a dangerously low blood sugar level. Many clinicians still consider that feature superior for preventing severe hypoglycemic events compared to Libre's alerts.
Okay, so direct competition from Abbott is intense. What about other major risks? You mentioned threats to their pricing and margins.
Yes. Beyond Abbott, the second major category of risk comes from regulators and healthcare economics. This could be an existential threat to their whole financial model long term.
How so?
In June 2025, the Centers for Medicare and Medicaid Services, CMS, the agency that runs Medicare, published a proposed rule. And this rule suggested that continuous glucose monitors might become subject to the competitive bidding process under Medicare Part B.
Competitive bidding, I've heard of that for things like wheelchairs or oxygen tanks. What does that typically do to prices?
It typically forces prices down dramatically. Under competitive bidding, suppliers basically submit bids for government contracts, and the lowest bidders win. It's designed to save the government money.
So if CGMs get forced into competitive bidding for Medicare patients, what's the potential impact on DexCom?
It could significantly slash reimbursement rates. That would likely lead to lower average selling prices, ASPs, not just for Medicare, but potentially bleeding over into the commercial market too, as private payers often follow Medicare's lead. It would squeeze margins across the entire industry.
Making that 1% gross margin guidance cut we talked about seem pretty small in comparison.
Exactly. DexCom's whole model relies on high volume, yes, but also on relatively premium pricing, especially compared to fingersticks. If the government effectively mandates much lower prices, the entire financial structure gets challenged.
Okay, that's a huge potential regulatory risk. One last factor, the rise of these new weight loss drugs, the GLP-1s like Ozempic, Wegovy. Are they a threat to CGM usage? If people manage their diabetes or weight better with drugs, do they still need a CGM?
It's an interesting dynamic, maybe not a direct head-to-head threat. On one hand, yes, GLP-1 drugs could potentially slow the progression of type 2 diabetes, maybe even lead to remission for some.
Which might reduce the need for intensive monitoring?
Possibly for some. However, DexCom and others in the CGM space argue the opposite. They counter that using a CGM alongside GLP-1 therapy can actually increase adherence and effectiveness for both treatments. By giving patients that immediate personalized feedback loop, they can see how the drug, combined with their diet and activity, is affecting their glucose levels in real time. The CGM acts as an accountability partner, a motivator, potentially leading to better, more sustainable results from the GLP-1 drug.
So maybe synergistic rather than purely competitive.
Interesting. Okay, this brings us to the final verdict then. We started with this contradiction. Explosive growth, huge market, but paired with internal chaos, quality issues, regulatory breaches. How do we reconcile these two opposing stories for the listener, try and make sense of it all? You absolutely have to hold both truths together. The potential reward is undeniable, and it's rooted in that structural strength. You've got the sheer size of the untapped Type 2 market, the proven success of the Stelo OTC launch showing broader appeal, the transition to the hopefully more profitable 15-day G7 system, a strong innovation pipeline with multi-analyte potential, and underpinning it all, that massive $3.3 billion balance sheet.
That all points to potentially years of strong double-digit growth ahead. That's the bull case, the reward.
That's the reward thesis, yes. Compelling.
But the risk side isn't some distant possibility. It's immediate, it's high stakes, and it even touches on ethical concerns around patient safety and regulatory trust.
Precisely. The risk is very real right now. The FDA formally declared the product adulterated because of an unauthorized change that, according to their review of internal data, compromised accuracy and risked patient safety. That is a profound regulatory breach,
And it's
compounded by the operational issues, the high scrap rates, the expedited freight costs, and the serious allegations from short sellers regarding aggressive accounting, like potential channel stuffing suggested by that record-high DSO. It all paints a picture of an execution and trust crisis that simply cannot be brushed off as temporary noise.
The interim CEO, Jacob Leach, he said on the call that the company's future of strong double-digit growth might not be reflective in the current valuation. He's basically arguing the market is overreacting to the noise, that the stock is undervalued.
And maybe he's right in the long run, but investors today are forced to weigh that long-term secular trend of CGM adoption and DexCom's financial muscle against these very immediate, very tangible risks. The unresolved regulatory noncompliance, the potential for further execution failures, and the looming threats of intense competition from Abbott and potentially devastating pricing pressure from CMS competitive bidding.
It's a complex balancing act.
It truly is. And maybe to leave you, the listener, with a final provocative thought that pushes beyond just the data points. If the FDA explicitly found the G6, G7 adulterated due to an unauthorized change linked to greater variability and higher patient risk, and if critics allege this change was potentially motivated, at least in part, by a desire to protect profit margins, how does that specific regulatory and ethical dimension factor into your long-term investment calculus? Especially when you contrast it with management's unwavering confidence, their very, very bullish stance, and their commitment to spending over $1 billion buying back shares right now. How do you weigh that inherent conflict?
Risk defined, portfolio protected.